Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
All right, let's jump into another deep dive. Today, we're going to tackle private equity strategies.
Sounds good.
You sent over a ton of case studies and articles, some pretty dense stuff.
Yeah,
But hey, that's what we're here for.
absolutely.
Especially, with that Blackstone Group Inc. Hilton Hotels deal.
Oh, yeah.
$26 billion to buy it and then flipping it for a $14 billion profit.
Incredible.
Clearly, there's more to it than just, having deep pockets.
Right.
With your background in corporate finance, I bet you're already seeing the gears turning.
Well, it's fascinating, how PE firms approach value creation.
Yeah.
They're not just about capital infusion.
Right.
They're strategic architects.
Interesting.
Before they even think about investing, they scrutinize three core factors: a company's financial health, its industry positioning, and its exit potential.
Okay, so financial health, we're talking about the usual suspects, right?
Yeah.
EBITDA, free cash flow.
Yep.
But maybe with a PE-specific twist.
You got it. They're looking for a solid track record of profitability and cash generation.
Of course.
That's for sure. But they dig deeper,
Okay.
analyzing a company's capital efficiency,
Right.
how effectively they're using their resources.
Makes sense.
They assess debt management capabilities and overall financial stability. It's
Yeah.
about understanding the company's financial DNA, so to speak.
Oh, I like that.
Yeah.
Financial DNA.
Yeah,
And industry positioning, that's got to be huge.
it is.
What good is a financially sound company if it's in a dying industry?
Precisely. Private equity firms hunt for companies with a sustainable competitive advantage.
Okay.
A dominant market share, unique product or service, a strong brand. Take Blackstone and Hilton Hotels.
Okay.
They saw a globally recognized brand and a vast network of properties,
Right.
but maybe not operating at peak efficiency.
Right.
That's where PE comes in,
Airy dad.
identifying that untapped potential.
Yeah, that makes sense. But it still sounds pretty high level. What did Blackstone actually do to unlock that potential?
Well, for starters, they implemented cost restructuring measures, streamlining operations across Hilton's portfolio. Think renegotiating supplier contracts, optimizing staffing levels,
Right.
even things like energy efficiency programs.
Wow.
They also revamped Hilton's global branding, pushing into emerging markets and modernizing the brand image to appeal to a younger, more affluent demographic.
Interesting.
It was a multifaceted strategy that went far beyond just pumping in capital.
So it's about finding those hidden gems.
Yeah.
Companies with solid bones, but maybe needing a bit of polish.
Yeah.
Or even a complete overhaul.
Exactly. PE firms are often attracted to companies that might be undervalued by the public markets,
Right.
perhaps due to short-term pressures or a lack of strategic vision.
Right.
They come in with a long-term perspective, a plan to unlock value, and the financial firepower to execute that plan.
Okay, that brings us to exit strategy. This is where the rubber meets the road, right?
Absolutely.
Because at the end of the day, these firms are in it to make a profit.
Right.
And a substantial one at that.
For sure. They need a clear path to cashing out their investment down the line.
Right.
And there are a few ways to do that.
Yeah.
We'll dive into those a little bit later.
Okay.
But for now, let's talk about how they finance these acquisitions, because we keep hearing about leveraged buyouts or LBOs.
Yeah.
And I think a lot of folks, myself included, could use a bit more clarity on how that works.
Yes, please. It sounds complicated, but I have a feeling it's a core part of how PE firms make these deals happen.
You're absolutely right. Think of it this way.
Mm-hmm.
An LBO is like buying a house with a really big mortgage.
Okay.
You're putting down a relatively small amount of your own money
Right.
and borrowing the rest,
Yeah.
using the house itself as collateral.
Uh-huh.
In an LBO, the company being acquired is the house.
So the PE firm uses the company's assets to help finance the purchase. That's a bold move. Are there any risks to that approach?
It's definitely a high-risk, high-reward strategy.
Yeah.
If the company performs well, the debt can be managed and the value increases.
Right.
Everyone wins.
Right.
But if things go south, that debt can become a huge burden,
Oh, yeah.
potentially leading to financial distress or even bankruptcy.
Got it. High stakes. Do you have an example of a really big LBO that illustrates how this all plays out?
Oh, absolutely.
Mm-hmm.
Let's look at Dell Technologies back in 2013. Michael Dell, the company's founder, teamed up with Silver Lake Partners to take Dell private in a massive $32 billion deal.
That's huge. But why take Dell private in the first place?
Yeah.
It was already publicly traded, wasn't it?
It was, but Dell was facing some serious headwinds.
Okay.
The PC market was shrinking,
Right.
and Dell was struggling to adapt. Silver Lake saw an opportunity to reshape the company, but they knew it would take time and some drastic changes.
So they took it private to have more freedom to maneuver, kind of like a pit stop, to retool the car without everyone watching.
Exactly. Public companies face constant pressure to meet those quarterly earnings expectations.
Yeah.
Taking Dell private shielded them from that scrutiny, allowing them to focus on a long-term transformation.
Right.
Silver Lake knew this wouldn't be a quick fix.
Okay. So what was the plan? What did Silver Lake see that others didn't?
They recognized that Dell's future wasn't in PCs alone.
Right.
The industry was evolving, and they needed to pivot.
Yeah.
Silver Lake saw potential in enterprise solutions, cloud computing, and services. These were areas where Dell had a foothold, but needed to expand aggressively.
So it wasn't just about, cost cutting. It was about investing in new growth areas.
Exactly.
But was Wall Street on board with that strategy?
Well, that's the beauty of taking a company private.
Yeah.
They didn't need to convince Wall Street every quarter.
Right.
They could make bold moves, invest heavily in R&D, acquire strategically, and build a new Dell, so to speak, away from the glare of the public markets.
And did it work? That's a pretty big gamble.
Yeah.
$32 billion is a lot of money to bet on a hunch.
It was a gamble that paid off big time. By 2018, Dell returned to the public market with a valuation exceeding $70 billion.
That's amazing.
More than double what they paid for it.
Wow, talk about a comeback story.
Right.
The Dell case really shows how PE firms can drive these huge transformations.
Yeah,
But it also highlights the importance of that exit strategy we talked about earlier.
absolutely.
So let's break down the main ways that PE firms cash out.
Okay.
You mentioned IPOs, strategic sales, and secondary buyouts.
Yeah.
Can you give me some real-world examples of each?
Sure. We've already talked about Blackstone's Hilton Hotels IPO.
Right.
A classic example of taking a company public and reaping huge rewards. But IPOs aren't always the best route.
Right.
Sometimes a strategic sale is a better fit.
Okay.
Take Burger King, for instance.
Okay.
Back in 2010, TPG Capital and Goldman Sachs sold Burger King to 3G Capital.
Why choose a strategic sale over an IPO? Wouldn't an IPO have generated a bigger return?
Not necessarily. In Burger King's case, 3G Capital was a perfect fit. They had experience in the fast food industry.
Right.
They saw synergies with their existing portfolio, and they were willing to pay a premium price for a well-established brand.
Right.
An IPO might not have fetched the same valuation at the time.
So it's about finding the right buyer,
Yeah,
one who sees the value and is willing to pay for it.
exactly.
What about secondary buyouts?
Sure.
You mentioned Carlyle Group and Acosta, right?
Yes, that's a great example of a secondary buyout where one PE firm sells to another.
Okay.
These deals can be quite complex with
Mhm.
multiple players
Yeah.
and intricate financial structures.
Right.
Sometimes a PE firm might exit an investment by selling it to another firm that has a different investment horizon
Okay.
or a specific expertise in that industry.
Okay, so these exit strategies are clearly crucial.
Yeah.
But why should someone like me working in corporate finance,
Right.
particularly for a PE-backed company,
Yeah.
care so much about what happens years down the line?
It's a great question. If you're in a PE-backed company, your work is directly tied to that eventual exit.
Okay.
The PE firm has a finite time frame in mind, typically 3 to 5 years,
Right.
and they're looking for a significant return on their investment.
Yeah.
Every financial decision, every model you build, every cost you scrutinize, it all feeds into that final valuation.
So I'm not just reporting to my CFO or CEO.
Right.
I'm essentially working for those PE investors,
Yeah.
even if I never interact with them directly.
In a sense, yes.
Wow.
You're part of a team working towards a common goal,
Right.
maximizing the company's value for that eventual exit.
Okay.
PE firms are laser focused on return on investment, and they hold the management team accountable for delivering on those financial targets.
All right. So what does that mean for my day-to-day work? What should I be prioritizing?
Think EBITDA growth, cost efficiency,
Yeah.
and debt management.
Okay.
Those are the metrics that matter most to PE investors.
Right.
They want to see the company generating more cash,
Yeah.
streamlining operations, and paying down debt,
Right.
all aimed at creating a more attractive acquisition target.
It's about building a stronger, more valuable company,
Yeah.
not just making the numbers look good for a quarterly report.
Exactly.
It's not just number crunching, it's strategic thinking.
You're helping shape the narrative of the company's growth and value creation.
Right.
You're not just managing finances. You're playing a key role in positioning the company for a successful exit.
It sounds like working in a PE-backed company is kind of like a crash course in value creation, but with a ticking clock.
That's a great way to put it. It's a fast-paced, high-pressure environment,
Right.
but it can be incredibly rewarding, both professionally and financially.
Yeah.
You're learning from some of the sharpest minds in finance,
Right.
and you're seeing firsthand how strategic decisions translate into real-world results.
We've talked about, the successes,
Yeah.
but are there any examples of PE deals gone wrong?
Sure.
Can't all be home runs.
Oh, there are definitely cautionary tales.
Yeah.
Yeah. Remember KKR's buyout of RJR Nabisco back in 1989?
Vaguely.
It was one of the largest LBOs in history at the time, $31 billion.
Wow.
But it became a poster child for the risks of excessive leverage.
What went wrong? Was it just a bad acquisition from the start?
Well, RJR Nabisco was a well-established company with strong brands, but the buyout loaded it up with an enormous amount of debt.
Right.
They implemented aggressive cost-cutting measures, which alienated employees and hurt morale.
Ooh.
The market shifted, competition intensified, and ultimately the company struggled to manage that debt burden.
Right.
It became a very public example of how a leveraged buyout can backfire.
So debt can be a double-edged sword.
For sure.
It can amplify returns, but it can also magnify losses if things don't go as planned.
Absolutely.
Any other examples that highlight those potential pitfalls?
Another one that comes to mind is Apollo Global Management's buyout of Caesars Entertainment in 2008.
Okay.
It was a highly leveraged $30 billion deal.
Wow.
And the timing couldn't have been worse.
Oh, no.
The Great Recession hit shortly after the acquisition. The economy tanked. And Caesars, burdened by massive debt, ended up filing for bankruptcy in 2015.
Oh, wow.
It's a reminder that even the most sophisticated PE firms can be caught off guard by unforeseen market events.
It's a humbling reminder that market timing and debt exposure are critical factors in PE deals.
Absolutely.
It's not just about the company's fundamentals, it's about the broader economic climate.
Right.
And the ability to navigate those turbulent waters.
Precisely. It's about understanding the interplay of various factors. The company's financial health, its industry positioning, the PE firm's strategy, the leverage involved, the exit timeline, and of course, the unpredictable nature of the market.
Wow, that's a lot.
Yeah,
That's why deep due diligence and careful planning are crucial.
absolutely.
We've covered a lot of ground here, how PE firms evaluate investments, the mechanics of LBOs, the various exit strategies, the potential risks involved.
Yeah, we have.
What are some key takeaways for our listeners, especially those working in corporate finance or considering a career in private equity?
First and foremost, PE is all about creating value, not just generating quick profits.
Okay.
They're looking for companies with solid fundamentals, but maybe some untapped potential.
Right.
Second, leverage is a powerful tool, but it needs to be used wisely.
Yeah,
Excessive debt can be a recipe for disaster.
for sure.
And finally, the exit strategy drives everything.
Right.
Every decision made from day one should be aligned with that ultimate goal.
Excellent points. Any final thoughts before we wrap up our deep dive?
Whether you're building financial models, analyzing potential acquisitions, or simply trying to understand the dynamics of your PE-backed company, I think like a PE investor.
Okay.
Understand their motivations, their strategies, and their focus on generating substantial returns.
Right.
That's valuable knowledge for anyone in the world of finance.
This has been an incredibly insightful deep dive into the world of private equity.
It has.
Thanks for guiding us through this complex landscape.
My pleasure. It's always great to share these insights and hopefully inspire the next generation of financial leaders.
That's a wrap on today's deep dive. We hope you found it informative and engaging. Until next time, keep learning, keep exploring, and keep diving deep into the world of finance.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.